Hey everyone, and welcome to this explainer. I am so thrilled you're tuning in today. We are going to be tackling a really fascinating, honestly massive, shift that's happening right now in the world of professional valuation. Look, for a long time, the bread and butter of an estate surveyor and valuer, an RSVE, has been traditional brick and mortar, tangible physical real estate. But our modern economy is evolving so fast. The true value of today's leading companies doesn't just live in the buildings they own anymore. It lives right there on their balance sheets in forms we literally cannot see. We're talking about business valuation, goodwill, and intangible asset impairment testing. Now, I know it sounds complex, and yeah, it is highly regulated, but stick with me. By the end of this explainer, you're going to see exactly how these invisible assets are rigorously quantified.
So think about it for a second. How do you actually value something you can't touch? If I asked you to value an office building, well, you'd measure the square footage, check the foundation, look at the neighborhood comps. Pretty straightforward. But how do you put a hard, defensible number on a brand's reputation? Or a hyper-loyal customer base? Or even the synergy created when two giant companies merge? This right here is the invisible economy. And for estate surveyors and valuers, stepping into this arena is the bridge between the physical world of real estate and the completely abstract realm of corporate goodwill. It is a challenging transition for sure, but mastering it, that's an absolute game changer for your professional practice.
Okay, let's look at the roadmap for today. We'll start with the macro valuation shift, then cover the rules of the game, walk through the impairment testing process, explore how to actually value the invisible, and wrap up with adjusting for market volatility.
Starting with part 1, the valuation shift, from brick and mortar to the balance sheet.
Right, before we go any further, we really need to nail down the absolute linchpin concept of this whole process, and that is impairment. So impairment happens when the carrying value of an asset, or a cash-generating unit, which we'll just call a CGU from now on, sitting on a balance sheet is higher than its actual recoverable amount. Basically, the company is saying, hey, this asset is worth X on our books, but the cold, hard reality shows they can only actually recover a value of Y, and Y is lower. So the crucial takeaway here is this. If that carrying value is higher than the recoverable amount, an impairment loss absolutely must be recognized. There's no dodging it.
Moving on to part 2, rules of the game, navigating global and local standards.
We aren't operating in the Wild West here. There is a highly synchronized global framework. 3 major pillars support international impairment testing. First up is IAS 36. This is your global core accounting standard, and it does not mess around. It mandates that goodwill and indefinite life intangible assets must be tested for impairment at least annually, or whenever a triggering event happens. You cannot just set it and forget it. Then we have IFRS 3. This dictates how goodwill is initially recognized during an acquisition, usually through a purchase price allocation. That sets your baseline. And finally, IVS 210 gives us the precise global parameters for measuring the value of those non-monetary, non-physical assets.
But look, we don't just operate in the global clouds. We have to adapt to local realities. Let's say you're conducting valuations in Nigeria. You're going to face a dual compliance situation. On one side, you've got the Financial Reporting Council of Nigeria, or FRCN, actively enforcing IFRS compliance. It's literally their job to make sure corporations aren't artificially hiding or underreporting impairment losses, just because the macroeconomic environment gets a little tough. On the professional side, the ISVARBN and NISIV codes dictate the ethical and practical rules for registered valuers who are branching out from standard real estate into these heavy corporate assets. So you're constantly threading the needle between global mandates and local enforcement.
All right, part 3, the impairment testing process. The 3-step IAS 36 workflow. Under IAS 36, impairment testing is a very structured 3-step mechanical process. It sounds like alphabet soup, but it's really straightforward. Step 1, identify the cash-generating unit. Step 2, calculate the value in use, or VIU. Step 3, calculate the fair value less cost of disposal, or FVLCD. Now, you might be wondering, why do we have to calculate both VIU and FVLCD? Well, because the rule states that your recoverable amount is whichever of those 2 metrics happens to be higher. That becomes your magic number.
Let's zoom in on step 1 for a second. Why exactly do we need this cash-generating unit? Well, because goodwill is fundamentally invisible and it's dependent. A company's amazing brand reputation doesn't just magically print cash all by itself in an empty room, right? It needs the factories, it needs the staff, the distribution networks. Because of that, you have to identify the CGU, which is defined as the absolute smallest identifiable group of assets that generates cash inflows largely independent of other assets. You basically have to build a fence around the underlying engine that makes that goodwill actually worth something. Now, here is where it gets really fascinating. The tension between steps 2 and 3 is wild because you are essentially calculating two totally different realities. Value in use, or VIU, is incredibly strict. It uses a pre-tax discounted cash flow model, but its biggest restriction is that it only looks at the asset in its current condition. You can't include future uncommitted restructurings, no fantasy improvements. It is strictly an as-is operational view. On the flip side, FBLCD adopts a market participant perspective. This asks, what would a typical rational buyer actually do? Well, they'd probably restructure and optimize things to squeeze out more value, right? So FBLCD allows you to include those future optimizations, and it's usually calculated on a post-tax basis. Whichever of these two wildly different numbers is higher, boom, that's your recoverable amount.
Let's hit part 4, valuing the invisible, specialized methods under IVS 210.
Okay, so when a CGU actually is impaired, we pull out IVS 210. Think of this as your specialized investigator's toolkit for extracting the value of distinct invisible assets. The first tool is MEME, the multi-period excess earnings method. This one is perfect for primary assets, like your core customer relationships. It cleverly isolates the specific cash flows generated by that target asset by subtracting what we call a contributory asset charge for all the other assets that help to make that revenue happen. Next up, the relief from royalty method. This is absolutely brilliant for trademarks and brands. Instead of trying to guess what the brand earns, you just calculate what the company saves by actually owning the brand instead of having to license it from someone else. And finally, the with and without method. We use this for things like non-compete agreements. It's exactly what it sounds like. You build two completely distinct discounted cash flow models, one with the non-compete in place and one without it. The net economic difference between those two, that is the value of your invisible asset.
Almost there. Part 5. Adjusting for volatility. Market metrics in emerging economies.
Listen, you literally cannot just plug standard global numbers into an emerging market valuation and expect them to be accurate. It won't work. You need a highly adjusted discount rate, specifically the weighted average cost of capital, or WACC. To get there, we start with the capital asset pricing model. Now, the super quirky thing about IAS 36 is that it requires a pre-tax discount rate for VIU, but all the observable market data out there gives us post-tax numbers. So valuers actually have to use this formula to calculate the post-tax WACC and then use some pretty iterative mathematical modeling to back into the pre-tax equivalent. It is a very rigorous statistical dance.
You absolutely have to tweak the variables in that formula if you're working in a volatile market. Let's break it down for Nigeria. Take the risk-free rate. Should you use short-term treasury bills? No way. They are way too volatile. You have to anchor to long-term sovereign FGN bonds, like a 10 or 20-year bond. For beta, sure, you source from global peer groups on platforms like S&P Capital IQ, but then you've got to unlever and relever it to perfectly match your specific unit's capital structure. Your equity risk premium, that needs to be a blended global premium that is absolutely adjusted with a specific country risk premium to account for structural sovereign risks. And finally, alpha. This might be the most important one. This is your specific risk premium. For local mid-tier businesses, you have to add alpha to account for on-the-ground execution risks, heavy customer concentration, or, situations where the entire company relies entirely on one key founder. And when it comes to the long-term growth rate, or G, guys, this is absolutely crucial. You're projecting cash flows out into perpetuity to find your terminal value. You're basically making a bet on forever. It is incredibly dangerous to let current, short-term high inflation anomalies dictate that perpetual growth rate. I mean, if inflation is temporarily spiking at 25%, you cannot just assume the company is going to grow at 25% forever. If you do that, you will create these massive, unrealistic cash compounding distortions that will completely destroy the credibility of your valuation. As a valuer, you must normalize G to align with realistic long-term targets, like the central bank's baseline inflation goals.
Well, we have covered a lot today. The macro shifts, the global and local standards, the precise math behind the models, and exactly how to tame market volatility. The bridge from physical brick-and-mortar assets to the complex world of corporate intangibles is built on really rigorous standards and advanced analytics. So, I'm going to leave you with this final thought. The balance sheets of tomorrow are increasingly driven by assets you cannot see. So, is your valuation practice ready for the invisible economy? Thank you so much for exploring this fascinating topic with me today. Keep learning, keep adapting, and I'll catch you in the next explainer.